Welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan.
My name is Lucas, and welcome to another one of our market macro updates. We are Beyond Bitcoin. We love talking about the developments in blockchain and crypto. So we've got many playlists for you to check out. If you're new, you are early and you're right on time. We've got tutorials to walk you through downloading a Web 3.0 wallet, sending, receiving, and just really getting into the nitty gritty. But we also have playlists and videos talking about the innovations and the developments all over blockchain and crypto. So if you'd like a one-stop shop, an education resource, subscribe, notification bell. We appreciate the love. But as you know, we also like to talk about the markets in general because blockchain and crypto, it's an emerging market in the grand scheme. And right now in the grand scheme, there's a lot going on.
That's right. Yeah. So let's touch on some of that. You might have noticed
By the way,
that
if you're new to this channel, I'm just cutting you off real quick. We're following up. This is a follow-up video. We've been our backgrounds in economics and finance. We really do like to talk about this side of the market a lot. And if you like to hear about the traditional finance and the Fed and the interest rates and inflation and supply chain and how that may or may not affect blockchain and crypto, we look forward to keeping you abreast because what's going on right now is something we've been talking about since winter, December, November. We've been foreseeing a lot of the monetary policies that are going to have to happen and take place. So hopefully at the end of this video, you have a better understanding of what the world is going through now, the economy, so that you can better prepare yourself and what to expect for the months and years to come.
That's right. And we want to make it clear, this is not financial advice. We are not financial advisors giving any kind of commercial or legal advice. This is just our own research and our passion for economics and finance, but just don't get confused. We are not here to tell you what to do or how to invest or what positions to take. That is all on you. But what we can do is hopefully provide some
the only
context.
thing we're telling you to invest in is if you enjoy listening to this information, you can donate below and invest in our donation address.
Invest in us, right?
Yeah, invest, but do your own research and invest in yourself first, right? But okay, yep. What's going on? What's going on in the markets right now, and why?
Well, there's been some air let out of the markets over the last 24 hours, going back to Friday. Big news was released. But before we get into all that, we'll just do a quick survey. You see clearly that there's been a lot of red in the last 24 hours. And some projects like Avalanche 9.4%, Polygon 9%. There's a lot of profit taking happening. And what is this driven by? Well, I like to always whenever there's blood in the streets in crypto, I always think, well, what's going on with the mainstream financial markets? This is Bitcoin. Here's the last day or so. You see, a couple red candles, and we're potentially bouncing off the support level. So we'll see what happens in the near term. But I don't think these levels will hold. We were talking about that, right? That it looks like we found support here, but if you look a week or two out, I think I would agree with you. The chances are we fall through and we find lower lows.
Let's say
right?
why. Let's say why. Let's just give the fundamental reasons why. If you're into technical analysis, then you could draw these lines and you could say, if we get support here, we can bounce up. And sure, that's true. But if we look at the fundamentals, we've been talking about the position that the Fed's in and that more rate hikes are sure to come. And there are other issues happening in the world economy when it comes to the supply chain. But when we look at the global market, the market worldwide, it doesn't look like in a month or two, the rates are just going to drop and we're back to bull season. We're looking at a time of austerity, and we were looking at rates going up for months, if not a year or two. We could be in, you pull up the chart, we'll get to it again later, but we look at the days of Volcker raising the interest rates that took place over a 5-year period. So how long this takes place, maybe not that long, but we still could be looking at 1 or 2 years of crab walking sideways and rate hikes and the effects it has. So even if we see support here, and let's pretend that, it supports and the price goes up to 30,000, 32, 34,000. What are the fundamentals driving the market right now? If the rest of the world is bleeding and they're dumping in the prices, well, Bitcoin at this moment although it's black swan possible for a random decoupling, it appears that at the moment it would also track down a little bit further with the rest of the market. So
that's right. Even with the technical, the pretty, support line we have here and the way it seems to be bouncing off of it, that's not going to be enough to overwhelm the fundamentals then these are not short-term things. We're looking at least 6 months to 18 months, maybe further, of a monetary contraction, to deal with this inflation issue, right? We spent so many years creating credit, putting money in the economy, and now it's not going to be solved, with a 1 or 2% interest rate hikes over over a quarter or two, right? This is going to take a lot more, and it's not, and the experts don't know, right? That there's a lot of disagreement between, is inflation coming down? Is it transitory? Is it entrenched? Is it escalating? And what exactly
what is the inflation rate? We're going to get into an article later on, but people don't even agree on what is inflation and how it's measured,
what
which
the rate is.
Nothing new. Right.
So before we jump into that, let's just do a quick survey of what the traditional financial markets are doing. Clearly, this was a historic Friday. You're looking at 3.5% of the Nasdaq fell, the Dow almost at 3% down, S&P nearly 3%. So we're talking about broad-based sell-offs. This is reminiscent of what we were looking at in 2008 and 9 at the peak of the housing collapse. So we've been here before, right? This is not uncharted territory. We know, and these things don't tend to just happen and just reverse, right? There's gonna these kinds of transitions, this kind of painful bear market activity tends to continue until something fundamentally shifts in the narrative to make us switch gears, right? So the thinking is that this is not going to be the end of what happens in traditional finance, and as far as selling off, and it's driven by some bad inflation data, right? So let's get into that, because that's really the core of what's driving this price action. So on Friday, we got the numbers for May of what the CPI and what the inflation metrics, what the data said, right? And it rose. The prices actually rose in the CPI to 8.6%, which is a jump of 1% from April. And that's a big jump. And it's higher than what the expectation was. So that's one of the keys, is that the month before, the data had some very, very minor indications that inflation was starting to cool down. And so a lot of the expectation in Wall Street and around was that, well, hopefully, fingers crossed, that for May it continues to cool down a little bit, right? And the opposite happened. It escalated. And now we're at a 40-year high. We haven't seen inflation accelerate this quickly to this degree in 40 years. I mean, that's just longer than I've been alive. I was born in '83, so we're talking about longer than my lifetime. Not much, only a year or two, but still, this is an intense deal. This is what people are looking at when they're choosing to sell their positions. And why? It's because the worse inflation is, the more that the Fed is going to have to raise interest rates and sell off their balance sheet and essentially contract the money supply. And when that money supply contraction happens, it leaves less money in the economy for spending, for investing, and the prices of everything come down. And of course, financial assets, which are generally thought to track the future flows of revenue of a company or an entity, those things are incredibly sensitive to changes in the interest rates, because we're talking about trying to discount future flows of revenue into a present price. And when that interest rate goes up, that discount goes up. So those present prices get a lot smaller. They become discounted even harder, right? Going to the higher rate. So higher interest rates are kind of like definitely a limit on the financial asset prices, right? They tend to reduce. The higher the rate goes, the lower the present price goes. So you can kind of keep that as a kind of simplistic model of how interest rates affect prices. And the more the Fed raises rates, what do you think that means? Obviously, these prices fall. So people who know that will sell. They don't want to sell later at a lower price. They'll sell today and try to get whatever they can, right? So that's what's going on there. Any thoughts before I go to the next
No,
slide?
you can move it on, brother.
Okay.
Well, I do have one thought while we're here.
Yeah.
Just note that in traditional finance, because there's a lot of talk about regulation and crypto regulation and getting a handle on things. We're not even talking about crypto. We're not talking about blockchain. We're talking about traditional finance, the Federal Reserve, and we're looking at major corrections going on in the stock market and sell-offs due to the issues at hand. So this is just, I bring this up because this is where we're at with the tools we are to be able to deal with money and economics. You can't even get people in traditional finance to agree on what is the inflation rate or what is CPI or how it should be measured. So there are a lot of unknowns. There are a lot of unknowns in economics and in the economy. So I just say to keep that in mind when people come out and feel that they're ready in charge and have a handle to regulate a new market and a new industry that's barely understood, when we're coming from an industry that should have the time to be a little bit more understood, and there's a lot more tools and a lot more control. Sure. And we still, even with all the technocrats in charge of the stock market and the SEC and the CM, we're still having major sell-offs. We're still having huge problems in recessions, in depressions, and so
that leads right into this. A Wells Fargo economist makes the point in one of their notes that tighter monetary policy is not going to help deal with the surge in commodity prices or in the structural problems dealing with the way people have changed the way they work after COVID, or dealing with Russia's war in Ukraine, or the COVID-related lockdowns, or the drought, or there's a lot of things, dock workers, contract expiring, labor shortages in key shipping areas, supply chains still recovering from COVID. So these things will not be solved with higher interest rates or selling off the Fed's balance sheet, right? Mm-hmm. So the idea there is that that opens the door to stagflation, a situation where the economy is retreating, economic growth and activity are receding, there's less activity, but guess what? Prices are still remaining high. You still have that inflation problem. And that's a kind of like a catch-22 for central bankers, because according to their modeling, this is a rare event. This isn't not even supposed to happen. I mean, if you look at the Phillips curve, which is one of the oldest, not oldest, but one of the most important tools that the Fed and central bankers use, it built into the Phillips curves is this understanding that inflation and unemployment are trade-offs. So when inflation goes up, unemployment goes down. And when unemployment goes up, inflation goes down. So in a world where unemployment is going up and inflation are going up, the central bankers don't know what to do, because they can't deal with one issue without kind of undermining the goal of the other, right?
Due to the way the model works.
Not just the way the model works, but just the tools at hand, right? You try to deal with inflation. Guess what? That means you're constricting the credit growth and the monetary growth. Well, now what happens to unemployment? That goes up because there's less money in the economy.
But my point is, that's where this model breaks down. The model works up until a point, but now the model's no longer working.
In these environments, that whole thing just goes out the window.
Right. And that happens a lot in science and in economics in particular, but models can be good at describing a phenomenon, but that doesn't mean that they're actually modeling reality. So sometimes we have issues come up in real life, the black swan, where the models that seem so elegant, were working so well for everyone, no longer work, and everyone's running around. They don't apply.
Right.
Which, by the way, I don't know if this is a good segue, if you want to mention it later, but we've talked about this in other videos. We're not just about problems. Understanding the problem means also having other ideas for solutions. And while everyone's focusing on interest rate, and you just pointed out there are a lot of other things going on in the economy that the interest rate won't affect, there are other things that politicians and people in position of different authority can affect. They can make choices that will relieve this inflation in other ways beyond interest rate.
Well, that's a great point. I mean, we're looking at a headline right now calling for or at least saying that there's a potential for a 75% or 75 basis point interest rate hike coming up in June, which would be like massive. You know, this is this would be unthinkable in a world where 0.25% rate hikes are kind of the norm, right? Even
Mhm.
half a point, which we just had, it was like mind blowing. Markets did not like that. So
Right.
looking at 0.75% of a percent would be, it'd be a large move. And the idea is that, well, hey, that's not the only tool here. That's like taking a chainsaw into brain surgery, right? Well, the economy's not that's not gonna necessarily work. And to your point, there are other tools. And one of the things that I think, we should look at doing, and not just me, it's not my idea, I'm just repeating it, is cutting tariffs, reducing the tariffs that have been increased and put onto the economy during the previous administration. They definitely upset supply chains. They forced nations to start sourcing some of their inputs and some of their imports from different areas, and changed the trade routes, and they basically upset the global pattern of trade. And undoing some of that, rolling those back, would immediately cut prices for the consumer just right off the bat, like, and by a pretty large margin. I think, I don't remember the exact number, but I remember it was like a whole percent off of the CPI, I think, in a year or something.
Right.
So we're talking about a significant increase in people's real incomes that they could immediately enjoy, and which basically is the opposite of inflation
So
be going down.
40-year record, a 40-year record of inflation. Was it inflation?
Has been broken. Yeah.
Has been broken. And whether or not you're on the left or the right of your political ideology, economics is economics, and this will work. So it almost feels like the economists around the administrations, I mean, they should be pushing. I wouldn't be surprised if soon we do hear of.
I agree.
It's like, why would you not? I mean, how does the knowledge exist when it comes to markets and economics and prices and money? We know that it will bring relief to the population. We know that reducing, this is the time, by the way, it's like, calm down. I know you guys love taxing things and tariffs, but right now people are losing jobs. There's no work. There's no money. A little easy on the tariffs right now. Let's go easy on that so people can start affording goods.
I was really surprised that it wasn't done, like first 100 days, even prior to the CPI and inflation story really coming out. I would have done it immediately. Like, we don't need this. Let's get out of it. Let's just change this. Let's go back to giving people a boost. Because, it wasn't like we were like the middle class and the lower classes were doing all that great prior to this inflation problem. There's always been needs for helping people out at the bottom. So yeah, I agree that and hopefully sooner than later that happens. So if you're watching Biden administration,
anyone,
let's do something.
Tweet, spread the word, just pretend, just say, why don't we just, remove tariffs, cut down tariffs?
Low hanging fruit. It wouldn't be hard. All right. Well, we've had some negative inflation data coming out. So let's look at some bright spots. And this is not bright. This is very much a kind of a mixed bag, I guess, because it's bright in the sense that it might help inflation, or will help inflation in the next, few months, years. But it's negative in the sense that, hey, this means that people's, their wealth is going to get reduced too. So it's a mixed bag in that sense. But what's happening is that the housing market's starting to cool down, and it's driven largely by what's happening with the Fed, and interest rates are going up, which makes getting into a mortgage, much more difficult, more expensive. So you're seeing the demand for homes kind of react to that. As the rates go up, the cost of having a house goes up, the demand should fall, right? All things equal. And that's what we're seeing. We're seeing sales are slowing down, inventory levels are rising. Sellers are starting to cut prices, list prices, the fastest they have since 2019. We're seeing there's a mortgage applications are 20% lower than in the same week in 2021. So lots of different signs that the housing market's beginning to kind of cool off or contract. And that's by design, right? That's what this interest rate policy is supposed to do. It's supposed to make it harder to borrow. There's less borrowing, there's less spending, and ideally that means prices come down. Now, if you're owning a home and you're trying to sell a home you've lived in for a long time, and you've enjoyed that price appreciation, you might not like this, because it means that your selling prices might come down a bit. But But in general, this is the kind of thing that needs to happen in order to bring inflation down, because housing is a major component. Housing expenses are a major component of these inflation statistics.
In
So
many
you
ways,
can,
it's a major component. You go back to, was it a Roosevelt? I forgot which president passed a certain act when it came to home lending, but really when it comes to banks being able to create loans for homes that they later on have
yes,
assets on their balance sheet that they can use to make more loans upon. I mean, this is where a lot of other money creation and wealth creation
happens.
derivatives
Right,
come from, not just the house itself. So
right.
we're looking at a major contraction. It ripples out, just like it ripples out on the way up. It also ripples on the way down.
That's a good point. Now, moving on from housing, we're going to take a quick look. We're going to run through these last articles really fast, not trying to stretch this out, but we're seeing oil prices come down a little bit. And that's counterintuitive. You think, well, why is oil getting cheaper in a time when inflation is, hitting all-time highs, 40-year highs? Gas prices certainly aren't coming down. So, what's happening with oil? And this is basically a function of consumer sentiment and also the lockdown in China. It's in being recent lockdowns in China that have come from COVID-19 concerns. So we're basically, the idea here is that both of these issues, the COVID lockdown and the retreating consumer, that the consumer
Demand
is weakening,
is dropping.
Yeah, and it should be continued. It thought to continue to drop.
We were talking about this a little bit before this recording, but we can mention again. If you really think about the structure of the economy, some of the things are these changes are forever. I mean, some of the things are never coming back. A lot of the loans, a lot of the gas that was being used up when people were driving back and forth to this company or that company or this job. The reality is we're living in a time where post-COVID, post-technology, many more people they're getting
they're working from home.
They're working from home, right? They're
ordering goods through
ordering
the internet.
food. They're ordering Amazon, right? We're not getting as many people driving to office buildings. Not as many office buildings are being leased out. Companies have already been finding ways to quit leasing commercial real estate. Commercial real estate's going to be has already started, will continue to take a big hit. And I bring this up because there's a lot of restructuring in the market and a lot of pain I feel to be felt. This demand that we're seeing change, it's going to be forever different. I mean, we're seeing a kind of a change in consumer habits and spending habits.
Yeah. So. And it's not something that we should just tie purely to inflation. This is something that's structural, dealing with technological changes, supply chain changes globally. The war is having an impact. Obviously, COVID. You're right. There's no reason to think that we're just going to go back to 2017 or 18 and just the world just picks up like it used to.
Well, it won't be like it again. I mean, many things were forever. The structure is already changing greatly.
Yep. All right. Last couple articles. We're just talking about Larry Summers. He's got a new paper out where it's you can read it. It's at the NBER, National Bureau of Economic Research. He's come up with a new model, a new method to analyze inflation, and he argues it's more accurate than the CPI, which has got a history of being accused of understating the inflation problem. So that's not surprising. And his conclusion is that from his data, that inflation is much higher than what we're saying. It's actually closer to the 70s metric, so the inflation highs of like the 70s. And he basically makes the argument that we are going to have to tighten a lot more than what we are, and that interest rates are going to have to go up a lot higher, and that if that's the case, then there's a good chance that there's a recession. The risk, well, at least if anything, the risk of recession is much greater. So yeah, we'll link this in below. You can go into the details if you like, if you're curious, but I don't think that's totally controversial. I think it's kind of very obvious, honestly.
Yeah.
And yeah, and this is another statement from Bridgewater. This is Ray Dalio's company. he basically makes the argument that the stock market's going to have to come down another 25% if the Fed stays on its current course. And I would agree. I don't see any way around that. We're at the beginning, not the end, of a tightening cycle, and 25% seems to be reasonable. And just to leave us off with some history, a little data, see where we're at in the cycle.
Well, and I'm just gonna, while you mentioned the Fed
go ahead.
funds rate history, I'm gonna say again why we bring this up. Obviously, Bitcoin, we talk about cryptocurrency, blockchain technologies, that we have a macro outlook. We're not trading channel. We don't say buy now, hurry up. We say do your own research, take your time. But if these projects are going to be around for a while, then it may behoove you to participate and to join, because when they do grow, this is an area for rapid growth. But I forgot what I was gonna say with that. Take over with the Fed funds rate. It'll come back to me.
Yeah, it'll come back. So what we're looking at here is a picture of the Fed funds rate. This is the rate that banks can lend to each other, overnight loans, short-term loans between banks. It's interbank loaning is what this is. But the rate is not determined purely by the banks or the market. It's heavily determined by the Federal Reserve, their open market operations, and they target certain levels. And right now we're targeting higher levels. That's what the rate hike is all about, right? And I just wanted to bring this up to show you that currently we are around 1%. So it's a little bit higher than what this chart shows. So this is not including the last couple of years, but we're around 1%, which is about where my cursor's at if you're looking at the picture. And just to show you versus where we've been at in the past, right? The rates have been so much higher in different periods. Obviously, in the Volcker days, we hit 20%. And that was very painful. I mean, that's how the stagflation of the 70s was ended. The monetary contraction and with a Fed funds rate of 20%. Well, and of course, in other periods, the dot-com boom came undone when the Fed raised rates to a little over 6%. The housing bubble in the early 2000s came undone when the Fed raised their rates a little over 4, almost 5%. And clearly, we're very low. So my point is that this is still a very accommodative monetary policy. Mm-hmm. We haven't gotten to the point where we're really in a contractionary stance. Right. And if inflation's at a 40-year high and it has to be dealt with, with all the tools available, then you have to know that rates are going to go significantly higher than they are right now. For some time. And for some time. Yeah. Right. That's the only point here. And I was going to mention this. You were talking about before the recording. I think it's important to explain this while people are listening. You see these going down, stepping down. Why can't they go up as high as before? There's a reason for that, because over this time period from that big crash, over this time, the debt that the United States has taken on over the last 20, 30, 40 years. I mean, we're the billions, much bigger. The trillions, all of a sudden we start throwing trillions around, this new number, trillions, and we're going to print another trillion. Well, the more debt you have when you raise the interest rate, the bigger the payments are on that debt. So there's not raising, like you were mentioning, whether 20% in 1980 on the debt back then is a lot different than 20% on the amount of debt that exists right now. It's untenable. Right. I do remember what I was going to say before. 25% correction, a 25% correction in the stock market, long term. Do you think that means that the crypto market is going to 2x or 3x or 4x during that same period? Yeah. No. Exactly. No, I would say it would probably do worse than the stock. Right. And that's my point, is that, do your research, and I mean, I still feel that in the long run, these are definitely early days, and sure, there are different projects that may be adding value and developing at their own timeline. But the reality is we're looking at contractionary time. So there's no reason to expect the Bitcoin or the crypto market just goes on some rampant tear. Where's that money coming from? Right. Where's the money coming from? Because right now, what we're explaining is that in the world, money needs to come out of the market.
we're talking about a major contraction and a correction. So that means it's coming out of, and we're already seeing it in crypto right now. That's why we're seeing these major.
And crypto acts more like tech stocks on the NASDAQ than it does a really safe investment on a blue chip. So if the broader traditional markets are selling off by 25%, then you can know that the risky plays like crypto are probably doing even worse. And this is not to say, be scared, be fearful, don't buy anything, don't take any positions. No, but it's just to say that be ready for some pain in the next 6 to 8 to 10 to 18 months. Who knows? But be ready for that, and don't maybe take a position now expecting it to have immediate gains, because you probably will be disappointed.
On the good news, I would say that these are great times, whether it's a few months or a year or two. This could be the opportunity. This really can be, for many people, the greatest opportunity of a lifetime, because the longer the prices are depressed and the correction is taking place, this is when people are able to scoop up opportunities at pennies on the dollar, because a lot of these blockchain crypto projects that are worth a fraction of what they were months ago, a year,
they're still developing.
They're still developing. They're going to have even more value and more utility in the future. So you take those same projects down the road that have even more dynamic, more utility. There's a good chance that the value of that will go even further than it was.
So there's still a lot of opportunity out there. You just have to be careful. You have to do your research, know what you're buying, understand the project, understand what they're doing. Don't just buy hype. But if you can do all that, you're right. There are opportunities out there.
And I would say treat it like college, treat it like a trade school, treat it like tuition. Be ready when you look at these prices. Be ready to see another 25%. If the stock market's going to go down 25%, be ready for 30%, 40%, 50%, 80%, 90%. It happens all the time. However, that's why we have a channel. We do drops, airdrops. We have a playlist on airdrops, because in the cryptocurrency community, even during these times, you will find that there are opportunities to grow, add to your portfolio. And it's how you learn. If you wait until the next bull market, you're going to miss out on many opportunities. You're not going to know what projects are building and adding value. So,
and the ones that you do want will have already been bid up to crazy valuations. Right.
Yeah.
So yeah, you're right. Opportunity is the name of the game right now, but also a little bit of what's the word?
Definitely taking your time and
stoicism. Yeah, in time.
But this is historic. The main thing we want to say is, hey, 40-year, a record, 40 years, inflation hits. So, and this is just the beginning. So if you like this kind of knowledge, and you like to learn about what's going on in the market with the Fed, with the economy, and in blockchain and crypto, and how some of these correlations, these causal relations work, and join the conversation with us. Drop a comment. We love to hear your thought. We learn from each other, especially when it comes to blockchain and crypto as well. There's so much development happening all over the place. We can only take in so much. But as we do, we look forward to sharing that research with you. I feel that did we cover most of what we wanted to with the inflation? Well, until the next time, have a beautiful day. Namaste, y'all.
Thank you.